A new survey says that 51% of you, half of Americans, are deeply concerned about having their money in the stock market. 3/4 of Americans are shying away from buying individual stocks. So if you're concerned about the market, where do you go to get earnings potential since the banks pay nothing? Some solutions coming up next on Your Money Matters, presented by the Presley Group.
And welcome back to Your Money Matters, your weekly peek inside the complex financial world. You listen to the show so you can retire with peace of mind. And what better people to tell you about that than Christy Smith, president of the Presley Group, and Matt Kennedy. Christy and Matt are experts at helping you plan for a successful retirement. They teach their clients how to position their retirement money to avoid losses due to stock market conditions. They have helped hundreds of clients achieve their retirement goals, and they can help you. Here are your hosts for Your Money Matters, Matt Kennedy and Christy Smith.
And good morning and welcome to Your Money Matters. I am Matt Kennedy, agent with the Presley Group. Christy Smith will be along ever so shortly. A really intriguing show to talk about today. There's a brand new study out. It was a study commissioned by the folks at bankrate.com. A really good website, by the way, if you haven't checked it out, bankrate.com. And the survey simply tried to gauge Americans' concerns about the stock market, now that the stock market has roared back and it's back at all-time highs. And the survey found that 51% of Americans are concerned about having their money in the stock market. 76% of Americans, according to this survey, 76%, 3/4 of you, are concerned about buying individual stocks because of the volatility. But, boy, that raises a really interesting question. What do you do? Because if you don't opt for the stock market and you pour your money into bonds and interest rates begin rising and you have to get out of that bond, you could take a loss. We're going to talk more about that with Christy coming up and how you have to be careful of over bond buying in this low interest rate environment. Or if you run down to the bank and you buy a CD, CDs are paying next to nothing. So what are your options? What are your alternatives? We'll talk about that as we go through the show today. But I want to start with more about this survey. The survey says 51%, call it half of Americans, are deeply concerned about the market. 76% are deeply concerned about buying individual equities and are opting for different strategies. And a few days ago, I had the chance to speak to Andrea Coombs. She covers retirement and retirement planning for MarketWatch.com. And Andrea was looking not only at this survey, but a survey that came out recently from the Employee Benefit Research Institute, where they said that fear of not having enough money in retirement was a big and growing concern among not only those who are about to retire, but even those in their 40s and early 50s. I mean, you're still a ways away from retiring, but after the scars of several market meltdowns, Andrea Coombs, this fear is real, and it really, Andrea, is a fear across all age groups, correct?
Well, older workers, it's true, have sort of, for a number of years, been more worried about retirement than younger workers, and obviously they're closer to it. They see it coming. They sort of have a greater understanding of the fact that they may not have enough savings. But what this recent survey found, actually a couple of recent surveys found, that the fears have definitely risen. More older workers say they're going to delay retirement. More of them say they're going to have to work at least part-time in retirement. So you definitely saw fears rising, and part of that could well be, the ongoing effects of the market downturn a few years ago. I mean, people, still are trying to recover from that.
And a general fear of the market itself, right?
That could be part of it. The surveys, they often don't go deeply into detail as to why people are feeling this way, but some of the theories of the people who conduct these surveys, one of them is that, it's this ongoing problem of people just, they didn't have enough savings in the first place, but then the market really ate into that. So they're still trying to recover from that. But another piece of this worry among older workers could well be that people are just more aware these days of what sorts of costs they face in retirement. The good news is they may be more aware of what they need to save. The bad news is they're close to retirement and they haven't saved it yet. And one of the big pieces of that is healthcare costs. You think, oh, by the time I hit age 65, I'll be eligible for Medicare, and that's a great thing. I mean, Medicare provides, is a strong insurance plan for the older people in our country. The problem is it doesn't cover everything. There's a lot it doesn't cover. It does not cover dental, hearing aids, long-term care. These things they can add up. If you have a number of health issues and you're on Medicare, you can have the costs add up. And there are a number of surveys that have come out recently that, some people estimate the cost to be, for a married couple, $240,000 in retirement for health care.
$250,000 just for health care in retirement. That's a stunning figure.
It is a stunning figure, and it really is going to vary depending on your own personal situation. That particular study does look really, they get at an average by looking at sort of average healthcare use. So it's a pretty, it's a pretty good figure. But yeah, there are people who won't get anywhere near that amount because they're just healthier. So that's another thing. While you're saving for retirement, also think about really trying to just keep your health, keep it good, because it's going to matter. The older you get, the more it matters, of course.
Your article is entitled "Retirement Fears Rise Among Older Workers." I thought one of the most intriguing things that you've discovered and pointed out, the pensions are going away. I mean, my parents had it, your parents had it, we don't. And so is it the loss of that guaranteed pension payout that has so many people worried?
Yes, I think that's a big part of it. But interestingly, one survey actually talked to people who do have pensions, people who are retired now and who have a traditional pension plan in addition to their own savings. And even those people are finding it, difficult financially in retirement. And, even those people who have pensions say they wished they started saving earlier, that they'd saved more. So it certainly wasn't having a pension isn't a panacea. But of course, it's better than not having one, which so many people face these days. You're right. I mean, more and more people do not have a traditional pension. And that's, it all comes down to we all need to save more. And there's two sides of saving more. One is if you could put more into savings now while you're working, not only are you growing that pot of money you're going to have, when you retire, but you're also learning to live on less. And that's that can really help once you retire. If you can budget that way, think about saving money, that's going to help you. You won't need as much in retirement. And that's, I think a lot of people, they face a different standard of living because they haven't saved enough. They face a different standard of living in retirement because they didn't save enough before they retired.
The numbers on savings, what I found interesting, Andrea, is that from the Employee Benefit Research Institute in their 22nd annual retirement survey, and you quote some of this data in your article, a third of workers aged 55 and older had only saved $10,000 or less. And even another third, about 29% of workers aged 55 plus had only saved between $10,000 and $100,000. So a lot of people they don't have significant savings or sufficient savings, and I guess they're trying to add more coal to the fire right now, aren't they?
Yes, I mean, the real issue for people in that group who really have very little in savings, Social Security is what they need. I mean, they are going to rely on Social Security, and which I should point out, there are some people out there who aren't eligible for Social Security because of their work history. Maybe they, for whatever reason.
Federal employees, teachers, things like that,
exactly,
right?
Exactly. So it's, but for the vast majority of people who don't have enough saved, it's Social Security, and there's a lot of talk right now about trimming benefits and what have you. I mean,
raising ages, yeah.
Yes, yeah. I mean, I think one idea that seems to be gaining traction is limiting the cost of living adjustment in Social Security, which it has a sort of, I won't go into the details of it, but the actual cost of living adjustment does have sort of a strange, it doesn't always fit the costs that seniors are facing. It doesn't rise. For instance, healthcare costs are under accounted for in that cost of living adjustment, while, when energy costs go way up, seniors are affected differently than people who are commuting, say. But still, so maybe the cost of living, the COLA, as they call it, isn't perfect, but changing it, reducing it, cutting it, as some are saying they want to do during this fiscal cliff negotiation, that's going to hit a lot of seniors. And you know, on the other side of the coin, there's the people are talking. You know, there's the deficit, and a lot of people say there needs to be changes there. Although there's some debate about that too. But still, you know, when you think about it, Social Security is keeping a lot of people out of poverty. It's a hugely important program. Yeah.
Andrea Coombs with us. Andrea, last but not least, you point out in the article that about 25% of workers say they may very well run out of money in retirement. I saw a piece of research the other day from a survey from, I think it was Allianz Life Insurance Company, and they researched and asked baby boomers, which do you fear more, dying or running out of money in retirement? And do you know more boomers said they feared running out of money more than death? I mean, this is a very real fear for some, especially those who have not saved enough, correct?
Yes, that's just a sort of somewhat horrifying statistic. But yes, it's it's a big fear. And again, Social Security is pretty much the only thing that's going to keep some people kind of, you know, treading water there. It's a really tough situation. I think, you know, people talk about a retirement crisis in this nation, and I think it is one. There are a lot of people who are going to struggle. On the other hand, I mean, there are a lot of people where Social Security is sufficient. There are people who have saved enough, and there's a sort of a wide, a variety of realities out there. But certainly for a good chunk of our oldest citizens, it's retirement is a very scary prospect, which is not a good thing in my opinion.
No. So in closing, what's your advice? I mean, clearly 2 words, right? If you can, save more.
That's exactly right. And really, for any people who are younger listening to this show or middle-aged, is still working, you know, really ramp up that savings rate, because it's just it's so much easier. The more time you have, the easier it's going to be to save enough. So just really, you know, think about putting aside 15% of your income, if not more, if you can. Obviously, that's not going to be doable for a lot of people, and I understand that. But really, if you can put aside 15% or more, you should start thinking about trying to do that.
Andrea Coombs from MarketWatch.com. She has lots of great columns, great articles every week at MarketWatch.com. We thank her for the time. So the moral of the story is, if you're younger and still working, still a ways off from retirement, save more. And if you're already retired and concerned about the stock market, the question becomes, Matt, where do I go? What vehicle, what instrument, what plan do I turn to protect and preserve and safely grow my retirement savings? Well, I'm glad you asked. When we come back, Christy Smith will join me. We'll talk to you about our plans. At the Presley Group, we specialize in plans that allow you to share in stock market gains in the good years, but these plans always protect you when the market is tanking. Now, there's a good chance your broker is probably not talking to you about these plans. These plans are plans through insurance companies, and most brokers don't offer these plans. But as insurance agents, we're able to offer you the chance to share in market gains in the good years and receive protection in the bad years. Great earnings potential from a safe investment. Back with more on Your Money Matters in just a moment here on Talk 107.3 FM. As always, we offer a free, complimentary, no-obligation appointment. Simply call us at 791-5773. That's 791-5773. Our office is in Denham Springs, right off of Range Avenue. 791-5773. Someone's at the office now. You can call and schedule that free one-on-one consultation to learn your alternatives to keeping your money at risk in the market. You can also visit us online at safemoneyplan.net. That's safemoneyplan.net. More of Your Money Matters next on Talk 107.3. And we're back on Your Money Matters here on Talk 107.3 FM. Christy Smith joining me now. Christy, great information from Andrea Coombs from MarketWatch. Her article and what we just talked about in the last segment focused on fears about not having enough money during retirement And there's another article that's out, this one from bankrate.com. Americans reject stock market investments. So there's one fear, I'm not going to have enough money saved for retirement. And there's another fear that's been realized in America, the stock market may take my money away. From this article that is at bankrate.com, only 18% of Americans say they are more inclined to invest in the stock market, even though interest rates are real low. But 76% of Americans surveyed are saying no to buying equities. And listen to this stat. 51% of Americans overall say they're afraid of the stock market right now. That's stunningly high.
Well, and I mean, we have to all agree that the stock market is at an all-time high.
It is.
And many people are really looking at their brokerage accounts and celebrating. I mean, I see it when they come into the office.
That's
they're patting
good.
themselves on the back. They're celebrating. But, you know, I wouldn't pop those corks off the champagne bottles just yet. You know, many economists are starting to predict that that there is a bubble and that the bubble is going to burst, and it's just a matter of when is it going to burst.
This article at bankrate.com, Christy, what it really points out, I think that's so interesting, what so many of us forget. Well, I'll just read from it. Recession-scarred Americans have largely set out the rebound in the stock market since the low in 2009. Now that stocks are at a high point, the same investors who wanted to avoid volatility may be saying, well, I can't get in now. It's too expensive. How many people did we see come to our office and say, yeah, I mean, I went to cash in 2008 or early 2009 because I was all worried about the market. But they never put their money back into the market. And now the Dow is approaching 15,000. Do you go put your money back in the market now? Because what if it is terribly overbought?
Well, and we actually hear people now saying, maybe I should consider going back. And the reality is the time now to go back? I mean, let's look at history. I mean, you know, in 2000, 2001, we had the dot-com bubble bust, okay?
Burst. Yep.
Burst. Then in 2007, 2008, well, we had the subprime mortgage bubble bust, you know? And my question for you is the next bubble, you know, what is our government going to name it? You know, I mean, we see a stock market that is very high, and many economists can't understand why it's so high. When you look at all the other economic indications that are performing so poorly, you know, you have to understand, or you have to ask yourself, why is it this high? And understand that the likelihood of a bubble bursting again is on the way.
Okay, let's come up with a name. We'll take credit for it. So we have the dot-com bust. We have the housing bust. I think you would have to, and we're not saying it's going to happen tomorrow, but if the market has a significant correction, I think you have to call it the monopoly bust.
I would call it the stimulus bust.
There you go. That's better. I was saying monopoly because we printed so much play money. I like that better, the stimulus bust. Here's the thing. When is it going to happen? Nobody knows. Is it going to happen eventually? Christy, you've got to think it is. We're not here trying to scare you. We're trying to say that it's very confounding right now for the individual investor. The market crashed. I got out. I was scared. The market has zoomed up. I've missed out on all the gains. Where do I go? Where do I go to get a decent return? Because back in 2008, you could at least go to a CD and get 3 or 4 or 5%. You can't do that anymore. You can't find decent returns, it seems, in a safe environment. However, we have safe environments that can give you a decent return. I promise we'd talk about that some in our last segment.
Well, you know, before we get into that, Matt, what I want to talk about is the fact that, you know, so many people hear the alarms, but they don't respond. You know, in 2006, 2007, we follow economist Harry Dent, and Harry was sounding that alarm. You know, the market's about to, you know, pull back.
Yeah.
How many people that I meet with that, you know, when they came in 2008 said, wow, this just hit me out the blue. I didn't even see it coming. There wasn't any warning signs. But in fact, there were warning signs. I mean, there were warning signs. The problem is that people didn't listen to the warning signs. We're starting to see those same warning signs now. A good friend of mine, he was just in the office last week from Topeka, Kansas, was telling me that he had the opportunity about 2 weeks ago to sit down with Harry Dent in Canada and did an interview with him. And he asked Harry, he said, Harry, where do you think the market's going? And Harry said, I'm expecting the Dow to hit 6,000. Well, if the Dow hits 6,000, think about how many retirement plans are going to be devastated, or even worse than that, how many people that have already retired that are living on their retirement money, how many of those people are going to see their lives devastated? You don't have to suffer through that. There are alternatives available. It's a new hybrid account. I say new, not really new, but people are learning about them more and more. In fact, 2012 was a record-breaking year for these hybrid accounts, fixed indexed annuity strategies. And the reason why these accounts are so good is because they allow us to link our return to an index on the market without putting our money at risk. So our money is always 100% safe. When we put our money in, we've got 100% principal protection. When we're on the brink of a bust, the bears are coming out. What we want to do is prepare and plan. Now, does that mean that we're going to see a pullback in the market in the next month? Maybe not in the next month, maybe in the next 6 months. What's important is that you evaluate now, learn your options, and take action before that happens. In a fixed indexed annuity strategy, we're able to link returns to market performance without bearing any of the risk.
That's so powerful. Let me say that again, just so everyone hears that.
Because we say it so nonchalantly,
we
because
just
we're
say
used to it.
Right. If you're one of those 51% who say, whoo, the market scares me, but you don't want to run to the bank because CDs pay nothing, these plans, these hybrid accounts, fixed indexed annuities, allow you to link your returns to external market indexes, like the S&P, the Dow, the Russell, the NASDAQ. We link your money to the market, but your money isn't in the market. The market only serves as a barometer for gains. So guess what happens? In the good years, like since 2009, 2010, our clients make decent returns because they're sharing in market gains. Now, you're not going to mirror market gains 100%, but you always have protection. So that if right now you're sitting in a 401k and you're over 59 and a half and you want to take some of that money out, if you've got an IRA that you've seen grow, if you have an after-tax account that's in the market and you've seen great recovery, you're back to where you were in 07, 08. Now's the time to think about, okay, how do I take some of the poker chips off the table? How do I put that into an environment where it's safe but can still grow if the market does keep going up? But more importantly, I need some protection if the market goes down.
But, Matt, one of the greatest features that an indexed annuity has to it, many of them have this feature, is that we actually can guarantee that a client's account is going to grow regardless of whether the market goes up or down.
That is powerful.
I mean, when you look at predictions, we can sit here comfortably and say Harry Dent predicts the market's going to go down. But the reality is that none of us really know when. We don't know. So the value is that if you go into a fixed indexed annuity or a hybrid account and the market goes down 30%, in a fixed indexed annuity, if you're saving for retirement income, we can actually have a contractually guaranteed interest gain credited to our account each year, regardless of market conditions. And often that contractual guarantee ranges anywhere from 3 to 10%, depending on the plan that you use. And of course, what would determine what plan you use? Well, that's naturally going to be based on your needs. Everybody's got different needs. But think about this. If you had $100,000 and you went into, let's use a plan we use a lot at the office called Security Benefit, Secure Income Annuity. Now, all advisors across the country don't have access to that product because that is a plan that was designed specifically for exclusive advisors, and we happen to be one of those exclusive advisors. So if you went into the Secure Income Annuity with Security Benefit and you had $100,000, you weren't planning on retiring for 5 years, you got an 8% upfront bonus added to that account. So day one, you start off with $108,000.
Okay, so hold on. They're going to give the client 8% up front.
Absolutely. That $8,000 is going to be added to the account immediately. Now, let's assume worst case scenario. Let's assume the market did not have favorable gains over the next 5 years. Worst case scenario is that account is going to grow a minimum of 7% every single year.
7% compounded growth.
Mm-hmm. Now, in 5 years, we know contractually that our $100,000 cannot be less than $150,000. Now, that's real peace of mind. That's real power, because now we can really have a roadmap for retirement. We can have a guarantee. We know under worst case scenarios, we're not going to be blown out of the water with our retirement plans.
And this goes back to the conversation I was having in the first segment with Andrea Coombs. She said retirement fears grow among older workers and younger workers, but particularly among older workers nearing retirement. So our strategies, our plans allow you to first and foremost be protected if the market does take a downturn.
Right.
But her other big fear that she talked about was, I'm not going to have enough money. I'm going to run out of money during retirement. Well, the plan you just talked about addresses that need. Not only does it protect you from the market, it grows your money at a guaranteed rate until you are ready to get retirement income, and then it pays out retirement income for your life and the life of your spouse. So we really are killing two birds with one stone. We're addressing both fears. Well, I'm afraid of the stock market. These plans aren't in the market. They're linked to the market. Well, I'm afraid I'll run out of money. With this plan, you can know you're going to have a steady paycheck as long as you and your spouse live.
Well, in the situation that I've been describing, let's say you were a 60-year-old and you started with that $100,000 and you saved, you didn't take a withdrawal for 5 years. And now our income value is at least $150,000. Actually, it's a little bit higher than that. We're able to then turn that income on as a guaranteed income. It's going to run about $600 a month. And that income is going to be guaranteed as long as you live and as long as your spouse lives.
So it's like flipping a light switch. You reach a certain point. Your money has grown no matter what's happening in the market. The switch is flipped, and the payments start coming out to you. And that payment is guaranteed to last as long as you're both alive.
And that's real important because, we all can expect that there's going to be changes made to the Social Security system coming ahead. There's going to be changes to the Medicare system, changes to the Medicaid system. There has to be, Matt, because the government has such huge deficits. And we hear $16.7 trillion deficit. That's not addressing the unfunded debt either.
Ooh.
That's just the money that's already gone out the door. And so when we look at the unfunded mandates that our government has right now, we're looking at over $114 trillion in unfunded mandates. So we know there are going to be changes ahead. What we have to do as individuals is empower ourselves to learn what's out there and understand that we're in a new economy and we have to do things different. If you'd like to give us a call and schedule an appointment to come in and meet with us, we'd love to meet with you, a one-on-one consultation. Or if you'd like to give us a call and receive a copy of our 10, I think it's called 10 Steps to Retirement Income.
It's 10 things you need to know about retirement income.
10 things you need to know about retirement income.
That's it. It's a great booklet, and it really doesn't push any specific product.
No.
It simply gives you a foundation for understanding what needs you're going to have in retirement. It's called 10 Things You Need to Know About Retirement Income. If you call us today, 791-5773, we'll send you out a free, no-obligation copy.
Or you can go onto our website, safemoneyplan.net, safemoneyplan.net. And also you can like us on Facebook. I know social media is the way of the future. We've got a great Facebook, The Presley Group. Go onto our Facebook, hit like. Therefore, you'll start receiving all of our information even on your telephone.
Again, it's always a no-obligation free appointment at 791-5773. Look, if you're in that 51%, that say you're concerned, you even fear the market, we can show you how to have gains that are linked to the market without having to fear market losses. 791-5773. What about bonds? What about bonds? We're going to talk about that when we come back in a moment. Many of you may be thinking, well, the safe way to go is bonds. Not so fast, says Bankrate.com. We'll talk about that in a moment when we continue here on Your Money Matters on Talk 107.3 FM.
There are plenty of people who believe a safe retirement is too good to be true. that there is no safe place for you to go with your money. Even your very own government will try to tax it right out from under your nose. But you've just tuned in to information that can save your retirement nest egg. It's Your Money Matters, featuring two of America's top retirement specialists, Christy Smith and Matt Kennedy with the Presley Group. They can teach you how to retire without all of the risks. Now, let's get back to Your Money Matters.
Good morning and welcome back to Your Money Matters, brought to you by the Presley Group. We're so excited to have you with us this Saturday.
I see it every day, and you do too with clients that come and meet with us. They say, but I've been with XYZ brokerage firm for so many years, and they've never told me there was an alternative to the market. They'll tell me, oh, well, don't worry, this time it's different, or don't worry, we're going to load you up on bonds, and we'll talk about that in a moment. But, folks, you have to know your broker is not necessarily going to tell you about these hybrid accounts.
Well, and the funny thing is I had a client come in the office yesterday, Matt, and she said that she went to her broker and she said, look, I think the market's going to be turning soon. I'm ready to – I want to actually cash in on some of my gains. And she said, that he warned her against doing that.
Wow.
And I said, well, why did he warn you against doing that? he had some reason why it wasn't a good thing for me to get out right now. But the statement she made that really stuck with me, and I think I'll never forget this, is she said, Christy, he didn't have an exit strategy. He did not have an exit strategy. And she said it became very clear to me as I expressed my concern about market conditions. And there's a lot of good brokers out there, but the reality is that their job is to grow and accumulate wealth. Their job and our job are really two entirely different things. Our job is to help people that are approaching retirement secure that retirement money, and then when they retire, give them a retirement income that they can't outlive. And you really have to think of this as a new economy.
Yeah.
Our government debt continues to soar. Our interest rates continue to remain very low. There's no hope right now that interest rates are going to really start rising in the near future.
No, I don't see interest rates going anywhere until at least 2015, if then.
So we have to think of things differently. Yeah. We have to look at retirement in a different approach.
All right, the headline at bankrate.com, Americans reject stock market investments. Now, this article was from earlier in the week, so if you go to bankrate.com, you may not find this on the homepage. Just search Americans Reject Stock Market Investments. You'll find the article. And what it shows is that 51% of Americans surveyed are deeply concerned about having money in the market. So the article goes on to say, in the month of February, bond funds had inflows of $34 billion.
Wow.
$34 billion went into bond funds.
That tells me there's a lot of uneducated investors.
This bond inflow, they write, has largely been a trend since the financial crisis began in 2008. The perception is, this is their words now, not mine, the perception is that bonds are always safer than stocks, but the risk in bonds is much higher than people believe. People with a very low tolerance for risk may be very surprised to learn the value of bonds will go up. The value of bonds will go down when interest rates go up, especially for long-term bonds. And Christy, if people think bond funds are a safe haven, you are sadly mistaken.
A lot of times what they're doing is they're going in and buying like junk bonds in order to boost up that return. And that can be devastating if we start to see interest rates rise.
Now, I do want to stress, and the article stresses this, bonds held to maturity are fine.
Yes.
As a matter of fact, that's what really undergirds our plans.
Yes.
Bonds held to maturity will pay the interest on top of the par value. But what happens if you have to cash the bond in early and interest rates have risen? You may end up losing principal.
Or what happens if you die and your family wants to cash in the bond early?
But bond funds, I think so many people get deceived thinking, oh, my broker's got me all in bond funds, I'm fine. Christy, I remember in 2008, we saw bond fund portfolios fall 15, 18%.
Yes.
You can really, so be very careful, the article says. But it brings us back to the core discussion. Okay, you guys say bond funds can be dangerous if rates start rising. Now, it doesn't look like rates are going anywhere for a while. But do you want to tie your money up in a 30-year bond And then one day rates do begin to rise, inflation begins to take off, and you have to cash in that bond. It's a strategy you really have to contemplate. Again, we've been talking about this article from Bankrate.com, Americans Reject Stock Market Investments. Earlier in the show, I had a chance to speak with Andrea Coombs from MarketWatch. She says there's a great fear among Americans, primarily baby boomers and those nearing retirement. The fear is, I won't have enough money, or my money won't last my lifetime. But we're also seeing in this poll from Bankrate.com, half of you are not only afraid maybe of not having enough money, you're afraid that the stock market may hurt you. Here's the closing paragraph from this article. When it comes down to it, they write, the deck is stacked against individual investors in many significant ways. Many of the most dangerous parts of the financial industry are hidden from view. For instance, the financial crisis revealed the scope of under-regulated derivatives. Financial innovations designed to make a few people a lot of money end up costing everyone tremendously. Wow.
I think the individual investors naturally, Matt, have a disadvantage already. Just because we're not on the inside. But the reality is that we are in a new economy. We're in a country that is filled with debt,
racked with debt.
We have a government that doesn't know the meaning of stop spending. We have a government that doesn't know the meaning of stop printing money, and we have 10,000 baby boomers that are retiring daily. Now, if this doesn't draw alarm and let you know that we have to start investing differently than we did in the past for our retirement, I don't know what else will. We have to do things differently.
The thing that I love so much about our hybrid accounts in the 5 years I've worked with you now is it's perfect for someone who says, I am afraid of putting my money in the market. There was a time if you were afraid of putting your money in the market, you just went down and got a 4, 5, 6% CD. And for most people, that met your needs. But the real challenge is in a low interest rate environment where a 2-year CD doesn't even pay 1%, maybe 1%, that's not even keeping up with inflation. And so many of you are thinking, well, I guess I have no other choice. I've either got to get into the market or I've got to buy bond funds, and then that carries inherent risk. Our plans offer you the same protection that you're going to find at the bank, the same principal protection, but we would like to argue, Christy, a much greater potential because we're using the stock market as a barometer. We want the market to do well, but if it doesn't, our plans protect, and that's what makes these plans so powerful.
Matt, one of the things that I hear time and time again from prospects that are coming into the office is that never in the past have they been able to create a level of certainty with their retirement. And that's really what these plans do. Now, if you're over 59 and a half and thinking you may retire in the next 5 years, now's the time for you to consider looking at your options. There is often the opportunity for us to take money out of your current 401k account. It's using what we call a in-service distribution. It allows you to take control of some of that 401k money now instead of going through that loss like you did in 2008. I mean, don't stomach the loss. You don't have to. We can make a real difference. And at the Presley Group, we're really helping people in any economy. Give our office a call. You can schedule an appointment to either come in and meet with me or Matt. Our office number is 791-5773, 791-5773.
Also, we're giving away a copy of the 10 Things You Need to Know About Retirement Income. Great booklet. Doesn't pitch any specific product. It just talks about the need for retirement income, things you may not have thought about during retirement, and needs you may have as you grow older. So call us at 791-5773. If you're out of the Baton Rouge area, toll free 1-800-791-5773, and we'll get that complimentary booklet out to you. Or you can schedule your visit. It's always free, no obligation, to talk about protecting and preserving your financial future. We'll be back with the closing segment of Your Money Matters in just a moment here on Talk 107.3 FM.